BBVA. I'm the Vice President of Community Lending, Mortgage Outreach Officer, and I am pleased, I'm thrilled to be sharing with you today this series that we have on financial workshop for credit today. And I guarantee today is going to be really informational. Now, when we get into diving into this particular subject, when we're talking about credit scores and reports, of course, it's impossible for us to pour everything about this subject in on one course or on one lesson. So make sure you tune back in here on those scheduled dates that we have, where we'll continue to share with you. We're trying to create opportunities for your community, and hopefully this information will be beneficial to you. So we're getting ready to get started right now. We're going to dive right into this, share my screen with you all so that you'll be able to see exactly what we're going through and exactly the PowerPoint or the presentation that I'm getting ready to present to you all. This is just a great time and a great opportunity for us to tool up and learn more about our financial wellness and to improve our financial stability in order for us to really be able to chart ahead. So I'm getting ready to share my screen now. You should be able to see it now. And so with it, credit scores and reports. That's up on the top of our page. So let's get started with this particular course. This is just a great time. So of course, there are four major workshop goals that we have to come out of this. Number one, that you'll explore the importance of credit scores and reports, learn how to access your credit scores and reports, discuss strategies to build and improve credit, identify how to protect your credit from incorrect claims and fraud. So let's go. So now this is a question that we normally ask. In an in-person workshop, this will be a survey that we would take. But I want to ask these questions to you this morning. I know you may hear me and some may be able to see the presentation as well. And I want you to begin to answer these questions for yourself. The goal in this is maintaining healthy credit. And I'm just these survey questions that I have for you, these 5 questions. Do you know your credit score? Be able to answer that for yourself, yes or no. The next is, do you always pay every bill on time? And the next is, my credit is not maxed out. The amount I owe is less than 30% of my available credit. The next is, I request a new credit report each year. And the last survey question, I review my credit report regularly. So I want you to think about those 5 questions that I had and begin to answer them in your own mind. Yes or no. Is this something that you do on a regular basis? Because we're talking about maintaining healthy credit. And I know at times when people hear us say maintaining healthy credit, we talk about credit as though credit is a being. Make sure that it's healthy. If we begin to protect and watch and manage our credit that way, as though it is a human being or as though it is something that's living, then we'll begin to be able to correct some of the things that cause us to have the errors with it in the first place. So the number one question, what is a credit score? A credit score is a 3-digit rating that tells lenders how likely you are to repay debt. You know, one time I had someone come into my office years ago as a young lady, and we were talking about it. She was just so new to the whole financial stability piece, and she was coming in to see if she could qualify for a home. And I asked her, I said, do you know what a credit score is? And she said, it's a 3-digit number that the devil came up with to keep me from having anything. And we laughed for a minute, but I said, we're going to work this thing out so I can dispel that myth that you have in your mind. So let's learn more about credit scores. So if we look at it, I know a lot of times some of you, don't know what level of credit you have or what category you fall into. 600 or less on your credit score, you're considered to have poor credit. People with scores that are 600 below could probably use help in rebuilding their credit history. Now, fair credit is usually between 600 and 670. That's what we consider fair credit, meaning that you may qualify for some loan products. You may qualify for the option to purchase a home or a car, but you may not get the best rates or pricing. Then we look at the credit score from 670 to 739. That's considered good credit, meaning that you would definitely be eligible for a lot of the lending products that they have for automobiles, for homes, and you will get some competitive pricing at that. But let's go even further. We should always have a goal to go higher than that. So if we look at the credit score between 740 and 799, that's very good. At that particular credit score, not only will you be offered some of the best products that they have, you're going to get the best price and the best interest rates, the best options to those particular loan products out without any shadow of a doubt. But hey, let's not stop there. Let's look even higher, from 800 to 850. That's what we consider excellent credit score. And so with that particular score, you're pretty much going to be pre-qualified, pre-approved for just about every loan option that you're looking at. You're highly favorable in the eyes of a lender. You shouldn't have any problems when it comes to your pricing. You're going to get some of the best pricing, some of the best rates, even when it comes to auto, when it comes to mortgage, when it comes to credit cards. Your credit score is really going to benefit you well in this. All right, let's look at building credit, strategies for building credit. So when we think about that, getting loans or proving your credit worthiness with poor credit or no credit may be very difficult. However, there are steps that you can take to improve your credit. Let's learn a little bit more about a few of those steps that we have. And again, with this short workshop we have, it'll be impossible for us to really dig into them all, but we want to share a few steps with you that can be beneficial to you. One is open a line of credit. Yeah, it goes back to that old cliche where it says it takes money to make money. Well, think about that in credit. It takes credit to have better credit. So sometimes you may need to open up a new line of credit, whether it be a credit card, a personal loan, a secured loan, or something. Any new line of credit that you're able to open up will help you out greatly in improving and building on your credit score. One reason being because it will increase your available credit. And anytime you increase your available credit, it will improve your score. Number two, request that your payment history be reported. Now, this is something that we run into a lot of times with clients who may, purchase a car at a buy here, pay here lot, or may purchase furniture at a furniture company that does in-house financing. Sometime with those lots, sometime with those furniture companies, they do not report to the bureaus. And so they keep a track of your payments. They keep a record of your credit with them, but they do not report it to the bureau. So in those cases, you want to make sure that if you find out they're not doing it, you want to give that information so that you can get it reported to the bureaus so that you can take advantage of that great payment history that you have with them. So you want to make sure everything that you're paying is reflected on your credit report. Number three, open a joint account. Now, I say this cautiously. Normally, when I say open a joint account, if you're in a relationship or if you're in your family and someone already has established credit, they may add you on as a user, a non-authorized user or authorized user on that particular account, which you will get benefits of their great credit history that they've had over the years. It will benefit you and it will improve your credit scoring that way. But opening a joint account, we'll get in that a little later on in this workshop, and I'll give you more details about that. Number four, pay all of your bills on time and in full. Never miss a payment. That's a big one. That, if we do, and really what that goes to is your credibility. Showing a lender that I'm credit worthy, meaning that I'm going to pay as agreed. It's a big deal to pay as agreed, meaning that contract that you signed when you took out that loan, you stated on that contract that if they granted you that loan, you would make a payment of X amount of dollars every month at this particular time. And so you want to make sure you're paying as agreed, as you agreed to. But anytime you have those situations, this is one thing I always tell people, Anytime you have a situation where you can't pay on time or it's beginning to be a credit crunch to you, reach out to that creditor. Be proactive about it. Don't wait until you get in the default. Be proactive, and it'll benefit you much better. Impact of scores. So when we talk about this, the impact of scores, we're going to take a look at a couple of different scenarios that'll really show you how a bad decision may get in the way of your financial goals. And so with this is something that I always get into. It's the tale of two friends. And I'm going to lay this out to you because I really want some people to hear this, and then they can look at their situation. You know, have you ever been in a situation where you see somebody where you've taken a parallel path in life, but it seems for whatever reason they seem to be excelling more than you financially, but you may work at the same job, may be in the same profession, may have the same, virtually the same personal life, but for whatever reason, it seems like they're excelling beyond you. And so look at this tale of two friends. It talks about Anna and Bella. Anna and Bella have been friends since middle school. They both own cars. They have steady jobs. They pay their bills. Anna's credit is 530, while Bella's credit is 700. Anna and Bella decided to buy homes in their childhood neighborhood. When they finally got their loans approved, one friend's interest rate and insurance was higher than the others. Within a few months, one of the friends fell behind on their mortgage payments and her home went into foreclosure. So who do you would think will fall into that category, to where that her lending, the interest rate, the insurance that she was granted made her fall into financial detriment? We already know. I know the question asks who has the better credit, Anna or Bella. It's really a no-brainer. Bella has the better credit. And so when you think about this situation that happened, we already know who would fall into that financial detriment. And that would be Anna. And the reason being, and I tell people this, nowadays, so many different financial tools that we use. So your credit score is, the higher of a risk you are to possibly file insurance fraud. I know, but this is the model that they use. This is what the information is telling them. So the higher the risk you are, the higher the premium you will pay. And so let's think about this even more. Anna and Bella, again, they've been friends since middle school. They finally got their loans approved. One's interest rate was higher than the other. Again, one fell into detriment and her home went into foreclosure. So who do you think had the most trouble getting a loan? Just off top, looking at Anna with a credit score of 530 and Bella with a 700, we already know who would have had the hardest problem trying to get a mortgage. It would have been Anna. You got to think about it. The lower your credit score is, it's only a few options that are laid out for you. With us, for a while, we did FHA at a 580. That was the lowest score that we will accept for any mortgage product we have. So with that, the lower your score is, the more likely you are to get in a product or have a program that will have a higher interest or limit how much you'll be able to buy, or also have mortgage insurance attached to it. Because again, the lower your credit score is, the higher of a risk you are. And so when you think about this, it asks whose interest rates was likely higher. It's a no-brainer. We know Anna's interest rate was higher because her credit score is lower. She's a bigger risk. She's a bigger risk than what Bella would be to a lender. And so that's the reason why her interest rate or her pricing would have been a lot higher. Her insurance rates the same way. They could have bought the same identical house. It could have been a production house that was built. Both of them purchased a home at $200,000 a piece. And for Anna, her insurance for the year may have been about $3,000 for the year. Where Bella, with the better credit scores, her insurance for the year may have been about $1,200, $1,400. So again, it's in the details of the things that we do. We have to be mindful of this. And this is the reason why we started off this workshop talking about maintaining a healthy credit, talking like your credit is a being. And so when we think about this again, we already know who would have had the most trouble in making their payments. The person with the higher payment, the person with the higher insurance premium, the person with the higher interest rate, the person with the worst loan, of course, they're going to end up finding themselves in financial trouble. Their loan isn't that good. The interest rate is high. The premiums that they're getting is high. So they're going to paint themselves in a corner when it comes to lending, which will result in them having trouble making their mortgage payments. And so this is the thing. So remember at the beginning, I asked you before we went into this Tale of Two Friends, I asked you about how many times we've seen this, to where that we have people that we seem to be on a parallel path with, but for whatever reason, they seem to be moving a lot further than us, excelling beyond some of us. And I'll give you this. I had another two people that I knew. I financed both of their homes. Both were teachers. Both graduated at the same time. Both were working in elementary school. Both were they were teachers. But one seemed to be, their incomes were identical. I think one may have made probably a few $100 more per year than the other did. But the reason, when I financed both of them, and the houses, the neighborhood they bought in was similar, but their pricing was similar. One bought a house for $175, the other bought a house for $180. So the pricing was very similar. But the one that bought the house for $175, her loan wasn't the best. Her interest rate was pretty high. She was really at the top. I mean, she was at the max that she could possibly borrow because her interest rate were high. Her insurance premium was pretty high. So it left her in a higher price mortgage than what she should have been in. While the other friend who had great credit, interest rate was very low. Her insurance premium was very low. And so, she was very comfortable. So she was not at the max of her lending eligibility. And so when you look at that, I've seen that happen too many times where people just financially were on two paths. So we may be on the same path, education-wise, employment-wise, but when it comes to the nuts and bolts of our financing, we may be on two different paths. So making sure you have healthy credit is one way that you can ensure that you're on the right path and on the path to get the things that you need. And so let's think about your credit. Credit scores, again, they can impact your ability to get a loan. They can impact your interest rates. They can impact your insurance rate. They can impact your ability to rent, your eligibility for credit cards, and your eligibility for auto loans and leases. And so let's look at this. Remember, we talked about your credit score, and there are three bureaus that are out there that come up with your credit score. They're TransUnion, Equifax, and Experian, and they have your credit scores. Each of them have their own systems to where they calculate your credit scores. And a credit score is a unique calculation as a combination of your scores from the three agencies or credit bureaus. And so when we think about this, how is it calculated? I go over this a lot, because people always ask, well, how is my score calculated? I do this, I do that. I feel like I'm doing everything right, but my score is just not going in the direction I want it to go. So one of the biggest pieces of that pie when it comes to calculating your credit score is going to be your payment history. And this primarily includes looking at whether or not you pay your bills on time. Your credit worthiness comes into question with this. And so payment history is really big. Number two is going to be amounts owed. That's another big percentage. How much do you owe on those loans? The percentage of your available credit that is being used is really big. I talk to people about this a lot. One of the quickest ways to increase your credit score is to increase your available credit. And so when I say that, a lot of times the quickest way to do it, if we have credit cards, are to pay those down. You want to stay at 30% or less of your available credit. Let me tell you what that will look like. If you have 10,000 combined in all of your credit cards, 10,000 as your high available credit, and you're only using 3,000 of all of that available credit, you're at 30%, you're doing very good. If you have 10,000 available credit and you're at 8,500 of that available credit, you're going to put yourself in a rough condition. It's going to really hurt your credit scoring. You have to think about it this way. If you have 85% of your available credit already used to a lender, to these algorithms, to these systems that run your accounts to see what your scores may be, your score is going to get hit very hard, because when you're spending that much of your available credit, it looks as though, or the system is going to believe that you're using your credit as though it is cash. And so you're painting yourself into a corner. God forbid you were to have an accident, loss of job, a catastrophic injury, anything like that. You painted yourself in a corner so tight that it's almost impossible for you to get your way out. And so that's why it's really important that you want to maintain your available credit, at least that always have 70% available and only use 30%. It would definitely help your scoring a whole lot. Credit history is another one that impacts your scoring. And when we talk about credit history, sometimes you may hear lenders call it credit experience. We want to see how experienced you are with credit. It's very good for you to say, hey, I've been paying, this 5,000 loan, this 10,000 loan, this 20,000 loan. I paid them all on time as agreed. So now I'm ready to borrow 200,000. Oh, we can go with that. You've shown us over a course of time, more than 2 years, that every loan that you got, you handled and managed responsibly. And now we can see lending you or letting you get to that next level of lending and possibly getting you a mortgage. So they look at it that way. But if I'm looking at my credit history and my credit history is short and my $5,000, $10,000, and $20,000 loan, I struggle with my $5,000. I kind of paid my $10,000 when I wanted it, how I wanted. My $20,000 loan, I paid it as agreed. But now when they look at my credit history and my credit experience, I'm not ready for that next level of lending because I struggled with 5, I struggled with 10, I'm barely paying this 20,000. So we don't want to set you up for default by lending you 200,000 when you couldn't manage the 5 and 10,000. So your credit history, your credit experience is really big. It tells a lot about you and your credit worthiness. Another one that has a big effect is new credit. We talked about that before, opening up new lines of credit, making sure, that can have a big effect on your scoring as well if you increase your available credit. But the other thing about it is when we talk about new credit, applying for a lot of new credit can be detrimental to you as well. So I know a lot of us, we go to these shopping stores, Nordstrom's, Macy's, Home Depot, all these stores. And when we get to the counter, every time someone is there, the cashier is always saying, hey, do you want to save 25% off your purchase by applying for this credit card? It seems like a good idea, but we know this is a store that we very seldom would go in. And so now we're going to have them to pull our credit. We're going to get another inquiry on our credit for this card that I may only use once every 6 months. And so you want to limit how many times people are pulling on your credit or how many times you're applying for new credit as well. Number 5, credit types. Credit types is another way of us looking at your credit experience also. When we say credit types, you have installment loans. Those are usually your auto loans. You have revolving credit, and that's going to be your credit cards and lines of credit. And then you have personal loans, also auto loans. So we look at all of that. We want to see a blend of different types of credit that you've had, maintained, and managed. And by doing that, by managing different types of credit and handling them in the way that they should, it bodes well for you. All right, so let's look at some more credit scenarios. All right, this goes back to what I told you guys before. I know we said it about, opening a joint account and how good of an idea that could possibly be if we were able to do that and if it worked out in our favor that way. But I'm going to tell you a cautionary tale, my friends. I'm going to tell you this. I only sign for or co-sign for someone or something if you know that in the event that they become delinquent, you're going to be responsible for that credit. If you can't say that, if you can't agree that, hey, if at any time they're going to default, I'm going to be responsible for that debt, then you shouldn't co-sign for them. I don't co-sign for anybody. I learned my lesson long ago, wanting to help, wanting to do my best for somebody, family member. It just didn't turn out that well. And so even this, and I'll tell you, some people think I'm just talking, but I'm serious about it. Even my son, when he went to college, he got an apartment. He called me from the leasing office. He was like, Dad, they said if you co-sign with me on this apartment, that I don't have to pay the $1,000 deposit. I said, okay. I said, put the leasing agent on the phone. The leasing agent got on the phone. I said, where do I send the $1,000 deposit? Because I knew right then I wasn't co-signing for anything. I know how kids are in college. You stay in one apartment, you like it, and then something happens, you want to move and just leave when you want to leave. And I didn't want to co-sign and be on the hook for paying the remainder of a lease out. And so I was happy to pay that $1,000 deposit because I just refused to co-sign for things like that. And so you have to be real cautious about that. I've had people sit in my office in tears after we pull their credit, and I said, ma'am, your scores are fine, everything seems to be well, but you have an outstanding repossession on your credit report that has to get resolved before we can lend you anything. And it was a car that she bought for her daughter. Her daughter needed the car, said that she would pay it. Then her daughter stopped paying it and didn't let her know until she began to receive repossession notices. Car got repossessed and it's on her credit right now, and she has an outstanding balance of $15,000. So while we were sitting in our office, I said, hey, do you think your daughter will be willing to call the lender and make a payment arrangement? Because if she makes a payment arrangement for 6 months where she's paying, then we could possibly not count this against you because it's in the process of being resolved. And she called the daughter right there while I was sitting there, and she told the daughter, she said, hey, you know how long I've been trying to buy a house? I'm in the mortgage guy's office right now. I'm trying to get things done. That repossession came up again. And one way that we could get past it if you set up a payment arrangement with the lender. And she told her mom, she said, you must be crazy. That's your problem. And she was like, I signed this car for you. And she said, that is your problem. And I was just like, okay, ma'am, what can we do? And so she had to leave my office that day defeated because, again, now she was unable to move forward with this purchase because she co-signed for someone that wasn't responsible. And not only that, she didn't have the wherewithal to take care of that debt when they went into default. So only co-sign when you're going to be responsible. When you can tell yourself right now, okay, I'll co-sign, and I know in my mind that if they go into default, I have the wherewithal and I have the will to go ahead and be responsible for this debt. If you cannot say that, don't co-sign. All right, credit reports. It's important that you review your credit reports regularly. It's one of the ways to build and maintain good credit. And so you want to make sure you're taking a look at your credit score as often as you can. Credit report is a snapshot of your credit history. Lenders like us use credit reports to understand how likely you are to repay a loan if we decide to give you one. And so I know some of you say, what's all in my credit report? All existing past loans, line of credit, credit cards, dates when those accounts were open, the amount that are owed on those accounts, and missed payments on those accounts as well. My credit info. So when we think about this, accessing your credit, the government has made it so easy for you guys to access your credit nowadays. They have something set up in annualcreditreport.com. This was the government's way of every year giving you the opportunity to get a free copy of your credit report from all three bureaus once a year through annualcreditreport.com. And so with this, it's just a great opportunity. I tell people you have to make it a habit. You know, like with me and my wife, we try to make sure we do it right around, every year we file taxes, we pull our credit. And again, we have 5 kids. At times we got doctor's appointments, this, that. And so we know every now and then they may have a duplicate of a copay that pops up on our credit, and we have to go dispute it and do something. But if we didn't review it, we wouldn't know that. So you have to get in habit of reviewing your credit often. I get asked a lot about the credit monitoring services, some of the free ones, like Credit Karma, Credit Sesame. I have no problems with them. I actually like them because, again, it's you taking responsibility, monitoring and maintaining your credit on a regular basis. I think they're very good in order for you to make sure nothing is going on. And then some of them allow you to do disputes online with them as well. So it's 4 steps when you're accessing annualcreditreport.com. Number 1, you want to log into that website. You want to request your free credit reports. Number 2 is going to tell you to fill out some information with your name, your birth date, social, your current address, previous address if you lived at your current place for less than 2 years. Number 3, you're going to select the credit reports you want. Yeah, you're going to select all 3. You're going to first select, I want Equifax, and it's going to give you Equifax one. You can save it to your computer or download and print it. And you want to choose the next one, TransUnion. Save it to your computer, download it or print it. You want to get the third one, Experian. Save it to your computer, download or print it. You want to review the information that you entered was correct, and then you want to access those credit reports. Another thing that I like about it so much with annualcreditreport.com, it now gives you the capability to dispute erroneous things or things that are in error on your credit report. You can dispute them digitally online, which means that it cuts the time on how long you get a response back. I may be dating myself when I say this, but a lot of us probably remember back in the day when we used to dispute our credit and you had to send a certified letter over to the creditor, and then they would send a letter back, and then you would send a letter back. We called it in the industry playing tennis. So it's basically like you just keep hitting that ball back and forth till someone gives up or misses, and then it will get removed or it may not get removed. But with the new system of annualcreditreport.com, you can dispute digitally, and the unique thing about it is it gives that creditor 14 business days to respond. If they don't respond in 14 business days, then that gets removed from your credit report. I've seen it happen. And so it's a lot quicker turnaround. Again, I'm dating myself, but I remember years in the past, it used to take almost 3 to 6 months for something that was wrong or an error to get removed from your credit report and your score to be adjusted. But with this system and the way they have it now, it can really happen fast for you. All right. So read my reports. When we're looking at our reports, there's a certain way that it's laid out in our reports. There are 4 sections of our credit report that we're going to see. One is going to be personal information. That's usually at the top of your credit report. It's going to have your name, your date of birth, all your personal information right there for you to verify. Then the next one is going to be our financial information. And this is going to show all the current or past accounts that are in your name, accounts that we signed for someone jointly. It's going to have everything in there. It's going to show the amount of debt you owe. And then it's going to show any missed payments that you had on there as well. And then the next thing will be our public record. Public record is going to be on there. It's going to show any legal cases, any liens or judgments that are against us, any federal tax liens that we may have, and then it's going to show bankruptcies as well. And then the last part of your credit report will really show inquiries or how many people who pulled your credit within the past 2 years. It's going to show up on that area also. Healthy credit. Remember, we talked about this, and I know I'm beating the drum to some of you like he keeps talking about healthy credit. You know I'm saying it this way because some of us or some people may have sick credit. You may have credit that seems to be in poor health. And we want to make sure that we build on the health that you have and get healthy credit. And so reviewing your credit information, correcting that wrong information are 2 steps that you can take to protect and build on your credit. Again, in this section here, the next section we're going to is making a plan. So as I read these off, these are things that we're saying right now. I'm going to have we're all agreeing to in unison right now that we're going to do these things. We're going to say, hey, this is what we're going to continue to do from now in order to ensure that we have good credit. I check my credit report for accuracy. I know the answers on here say already do or start doing. So if you already do that, that's a plus. If you're not doing that, let's start doing it. Number two, I check for incorrect reporting of my credit. If you already do it, that's a plus. If not, we want to make sure we start doing it. Number three, I check incorrect reporting of my account balances. Again, if you already do, it's a plus, but if you're not, you need to start doing it. The next, I check for incorrect reporting of missed payments. Already do. If not, you need to start doing it. The next one, I check for incorrect reporting of negative public information. Already do, and if not, you need to start doing it. And last, I check for the dates and number of credit requests. Already do or start doing it. Now, when you look at these things, these are actually items that you can use to help improve on your credit on your own. Yeah, you don't need a company to necessarily, do credit repair for you. In certain instances, you may, but this is telling you if you can check these things, and you can do all of this from annualcreditreport.com. This is the thing. I told you they gave us the opportunity to pull that credit report once a year. Well, since we've been in this COVID environment, the current administration decided and gave us the option to be able to access our credit at annualcreditreport.com once a month, free of charge, to review it. And I'll tell you the reason why. Even though we're in a financial decline, even though a lot of people may be home, loss of jobs, loss of income, this is the time. I know it's going to be kind of, shocking to some of you, but this is the time when most of the fraud and scams happen. And so this is the reason why the government has given us an opportunity to check our credit monthly to make sure nothing is happening fraudulently, make sure we haven't been victim to any scam or any identity theft, because during these type of times is when all of the vultures and wolves come out, and they will try to take advantage of you. So be mindful of that. Make sure that you're looking and reviewing over your credit report regularly. If you're using any of the credit monitoring apps, Credit Sesame, Credit Karma, please continue to do so. Continue to do so so that you can maintain and protect your healthy credit. All right? All right, review your credit report. And this is, again, what we're talking about. Review important dates. When we're looking at it and we're looking to dispute certain items, you want to make sure you review important dates. Because sometimes dates can be thrown off in there and they can cost you as well. Say, for instance, you signed up for an auto loan and it's a 60-month loan, and they got it listed out, 60-month loan. You got this loan January 1st, 2015, which means January 1st, 2020, that loan should have been paid off. But for whatever reason, on your credit report, it's stating that you got the loan on January 1st, 2014. So now, instead of it being a 60-month loan being paid in 60 months, it's a 60-month loan that got paid in 72 months. So just for that little error, it changed it from being paid as agreed and on time to that you had been slow paying that loan. So if the lender is looking at it, it looks as though you've either made some kind of alternate payment arrangement or did something different. But anyway it goes, you've been slow paying, and then you will get a hit for that inaccuracy. So you want to make sure those dates are correct. It may be some things on there, accounts that you have closed, accounts that you've already paid off, and they're not showing the right date as to when it was paid off. Make sure that you contact them to get that change. You want to make sure you correct correction errors from the credit bureaus and businesses as well. So when I tell you about, making sure you do the correction on the bureaus, you don't want to just dispute on one bureau. No, it'll help, but it's not going to benefit you totally. You want to do a dispute. If you find something wrong on Equifax, you want to go on TransUnion, make sure they got it right on there. You want to go to Experian to make sure they have it right on there. and if need be, and if you have to, dispute on all three bureaus. That's the way that you make sure that it's removed and it doesn't affect you anymore. You got to dispute it on all three bureaus to make sure it's removed off. Now, this step, the other step says mail documents. Now, again, I told you how we used to do it before, where we used to have to mail documents, certified documents to prove either it was paid off or it was done. With the new digital system, oh man, the good option that they have, it gives you the ability to scan and upload documents. So that cuts out more time. It makes it easier for you. It shows you when the document is uploaded and listed on there for you, so you know that they've gotten the information that they need in order to remove it or correct it. Right? And you want to make sure after you've done that, you get responses from the bureaus, and usually the bureaus will respond after those 14 business days is what they give the creditor. And then normally you'll get a response from the credit bureau probably in about 21 business days. Either letting you know we reviewed it, we submitted your dispute, and we found that you were correct, and we removed the item off. Or it may say, hey, after investigating your dispute, we realized that no, that is correct, so it's going to remain there. But you'll get notification from the bureaus usually within 21 to 30 business days. Now, I hear this question a lot when people ask about credit repair. Are there special circumstances when I need credit repair? At times there may be. You may need to have a credit repair done if you're coming out of bankruptcy, foreclosure, or divorce, meaning that you may need someone to help you really repair credit, reestablish, and get everything situated. So those are some reasons and some ways why. Okay. So now we're going to look at some strategies you can use to reestablish your credit after a bankruptcy, foreclosure, or divorce. Number one, this is the big one, what we've been hammering thus far. Monitor your credit report and scores. Continue to review it on a regular basis. Number two, it's going to be to pay your bills on time. Nothing builds credit faster than regular and consistent payments. Pay your bills on time, as agreed. Number three, in certain cases, you may need credit counseling. Number four, consider new financial products. You may want to do that as well. Remember, we talked about adding new lines of credit. Consider other financial products that can be offered to you that can help you rebuild your credit. We have a couple of credit unions here in Florida that do these self-help credit loans to where that is basically like a secured account they'll allow you to open up, and they'll match whatever you put in there to secure. So if you put $250 in there to secure, they're going to match it with $250. You are up to $5,000. You put $2,500 in there, they're going to match you with $2,500. And it's a way that they can help you build your credit. So consider new financial products. All right, now we're going to tap into this. Know your rights. Know your rights. Now, this is a big one. And I have to, we get to this section. This is one that I really I want you to really take a close look at this. It's called the Credit Repair Organizations Act. So it's a law. Per this act, credit repair organizations must do the following 5 things. 1, they cannot engage in false advertising, deceptive practices that can cause you harm. So yeah, when you see those signs saying, hey, we can give you brand new credit for $299, that's wrong. And they need to be reported. There's no way that they give you brand new credit for $299. Number 2, provide you with a copy of the Fair Credit Reporting Act. So if you're going to a reputable credit repair organization, they should have no problem giving you a copy of this law. Number 3, they got to be transparent about everything they do. Number 4, they cannot charge money for their services until they have completed the job. That's right. So anytime they ask you, hey, we need an upfront fee of $299 before we start working on it, you need to run right away because they cannot charge you money for services until they complete it. And number 5, they have to provide you with a contract that you may cancel the contract within 3 days after signing it. All right. Now, this is a big one. We're going to get in here because I want you guys to be able to spot a credit repair scam. It's so many of them going on. I see that advertisements on Facebook. I see them on Twitter. I see signs on corners about credit repair, but there's so many credit repair scams going on, and I'm going to help you to be able to identify them, okay? All right, now we're going to read this. I'm going to read this out to you. Credit repair scams. After her house fell into foreclosure, Anna researched several credit repair agencies. Yeah, we're back on Anna again. And the first agency that Anna found in her research promised to remove all bad credit information from her report. All she had to do was pay a fee up front. Anna was worried about her bad debts, but the company assured her they could scrub all the negative information from her report. They also advised her, do not contact the credit bureaus directly, as it would negatively impact their efforts. How many red flags did you catch in that statement? There was a ton of them, I tell you. So the first red flag, the first one that should have jumped out to you all when you heard me reading this, or if you read along with me, was that the first agency promised to remove bad credit information. It's a red flag because, again, something on your credit may be bad that they cannot remove. So they can't promise you that they're going to remove it. It's some things, the only way that they can be removed, they have to be resolved. So when you spot this scam, sometimes they try to tell you they can remove it without resolving it. Cannot happen. Will not happen. All right. The next red flag. This is a big one. They told her they required Anna to pay an upfront fee. All right. And let me tell you the reason why a lot of them want you to pay an upfront fee. It's because if they tell you, hey, you pay when we're done, if it's a scam, they know they're not doing anything. So when they tell you they're done, they have nothing to show you, nothing that you will pay for, and you will never pay them. So the way they handle this game is they get that money from you up front, and that's their pay that they're going to get because they know that when they finish, you will not pay them for anything else. So it's a big red flag. And the next red flag, this is something too that I see. I saw this recently. Somebody sent this over to me on Facebook, like, hey, Bridge, take a look at this one. And it said that anytime a company assures you, promises you that they can scrub all negative information from your credit report, it's a scam. Remember, some things on there may not be able to be removed until they're resolved. Just like I was telling you earlier about the young lady with the repossession, that wasn't going anywhere. That creditor had already said they weren't going anywhere until they got their money or settled with them. So it's something that was not going to be removed. They had enough. It was a big enough company. They had the lawyers. They had everybody else. They were not going to let go until they got paid, until it got resolved. So anybody that promises you or assures you that they can remove all the negative information, man, they telling you that they're selling you they're selling you a bridge to nowhere. I'll tell you that much. And then the last red flag, and this is something I've heard them mention, when they tell you, please, no, don't while I'm working on your credit repair, don't contact the credit bureaus. That's a red flag. The reason why they don't want you to contact the credit bureaus is because they know if you contact the credit bureaus and say, hey, I have this company working on my behalf to improve my credit, I'm just calling to see how, what they've been able to do. 9 times out of 10, the credit bureau is going to tell you nobody's doing nothing on your credit profile. Nothing is happening. I don't know what you're being charged, but nothing is happening. And so that's why they don't want you to contact them direct, because their gig will be up. They'll be shown to be a scam. And so they don't want you to contact them because they don't want you to find out what they're doing before they get done. All right. Debt counseling service. So, we used to call this before, it used to be called CCS, Consumer Credit Counseling Services. And so with this, this may help for some people. I hear some of the things that they do, and I heard, but before I dive too much in that, to get back to that credit repair, not all credit repair companies are scammers. I'll tell you that now. There are some reputable ones out there. I'll tell you, do your homework. If you're not willing to do your work yourself, do your homework, research those companies, look at the ratings, see who they provided help for. I've seen some of the groups that do it that have been really successful. Sometimes they're the groups that are attached with the attorney's office, and they kind of litigate a lot of that stuff to mitigate the negative impact on your credit. And so those groups have been pretty good and shown themselves to be successful at doing it. But whoever you pick, if this is what you want to do, make sure you do your homework behind them. All right, debt counseling services. So when you need debt counseling services, one of the first things they're going to make you do, you're going to have to write down all your current debts on paper. You're going to have to write down your monthly expenses. You're going to have to make a monthly budget. And then you're going to have regular contact with your creditors about your debt and request modified payment plans if necessary, and request and receive your free credit reports regularly. So when you talk about those those debt counseling services, one thing that I've seen them do, because I've had a couple of clients that may have used them, one thing that I have seen them do, normally they will get your credit profile, they will have a meeting with you, they review your finances, they will create a budget with you. They will help you be able to budget for the future to make sure that you're not getting yourself into that same bad pattern that brought you to their office in the first place. They're going to make sure that you're doing the things that you need to do in order for them to help you. And then they go a further step, because in that meeting, normally they will begin the process of reaching out to your creditors and asking them for modified payments, asking them to do certain things to help you. And normally what you would do, you would pay them a fee, a nominal fee on a monthly basis. And then you would send them the money that pays your bills out for you. And so that's one way that they help you in managing your debt and decreasing your debt and keeping you, basically just keeping you responsible for your finances. All right, strategies to improve credit. A few good habits and strategies for managing credit and debt can really help improve your credit. Again, this is what this whole course has really been about, just helping you to improve your credit, to get healthy credit. I know some of you credit that, may seem like it has a cold, but we want to get that credit healthy. We want to get that credit vibrant. And, the benefits of doing so, this is why this is so big. The benefits of doing so. I've seen people where one person has a car that's 5 years old, one person has a brand new car, and they have identical monthly payments. And the only reason why is because the person with the 5-year-old car credit is not so good, so they have a high interest rate on their loan. And so now they're paying the same amount of payment that the person on this side is paying for a brand new car. It can have some really serious effects to you. It can affect where you're trying to stay and live. Again, now all landlords and even rent management companies are reviewing your credit to ensure that you have good credit before they extend that lease for you, before they allow you to move into their property. So the strategies, again, for improving credit, you want to use your available credit wisely. Try to stay below that 30% if you can. You want to pay your bills on time. Pay off your credit cards each month as possible. You want to pay your loans on time. Do not apply for a lot of credit accounts in a short period of time. Don't let everybody willy-nilly pull your credit. Even if you're shopping for a car, go in that dealership, know your credit score, and then tell them, hey, my credit score is XYZ. I just want to find out what you can do. Do not let them just pull your credit. And if you happen to let one dealership pull your credit, once they tell you what your scoring is, if you happen to go to another dealership, say, hey, I just left ABC dealership, my score is this. What can you do? You don't want to give them the opportunity or authorization to pull your credit again, because what those dealerships do is they shop your credit to 9 different lenders. So going to 2 dealerships, letting both of them pull your credit is going to show up like you have about 18 different inquiries on your credit report, which is going to tank your scores by at least 20 points. All right. You want to make a financial plan or debt management plan to reduce debt. I'm going to repeat that one. You want to make a financial plan or debt management plan to reduce debt. All right. That's really big. And the next, create and follow a monthly budget. You got to do this. It's going to really help you in the long run to create a budget and stick to it. I know sometimes it seems like it's so hard, like, oh man, I want to do this. But no, you got to really be responsible, because you have to think about what the big picture is. If you're trying to own a home, that home is more important than red bottom shoes. That home is more important than going out, to restaurants 3-4 times a month. That home, it should be more important than buying some frivolous things at a store. So you want to make sure you make a budget out for yourself, have a plan, have a goal, keep that goal in mind, aim for it, shoot for it, and achieve that goal. And the last one, this thing, which is really big, periodically review your credit report for accuracy. So I already told you, annual credit report lets you do it on a monthly basis. So you want to start doing that on a monthly basis just to ensure that everything on there is correct. And if you have Credit Karma or any of those, you want to make sure you're doing that as well, just to make sure everything is correct. And so now we're coming to a part of our course to where we really, we're getting to the point where we're able to, close this thing out. And again, I would be remiss if I did not introduce one of our fantastic mortgage banking officers, Mauricio Trulio. He's based in Colorado, but he's a wealth of information, a great guy, just a wonder to work with. And I know he can contest, and I see he's in our chat box answering some things, but he can tell you the times that we have people come in our office, and we really want to help them. We're really doing all we can to possibly put them in a mortgage, to possibly help them work out their situations. But due to some problems that they created on their credit, due to them not being responsible, having a budget, making sure they maintain their finances the right way, due to things that they correct. A lot of times the issues they have are self-inflicted. And so that's why these calls that we're going to have, this financial workshop and literacy series that we're having with God Radio 1, they're so important. And I just thank God Radio 1 for giving us the opportunity to come share with you guys, because again, we want to create opportunities for you guys. Anything that we can do, we want to do it. So let's remember these key takeaways from this. It's important to review your credit reports regularly. I can't say that enough. And remember, you can access them for free from annualcreditreport.com. Number 2, remember this, that your credit score is a reflection of your financial and debt management practices. So you want to make sure that that reflection, it accurately reflects who you are. Number 3, always pay your bills on time and never default on loans. Number 4, it's possible to repair bad credit by managing debt and credit responsibly. And a lot of this work, I can tell you, a lot of these things that can be done on your credit report, you can do yourself. They just have it kind of set up now where you can really dive into it and begin to do it yourself. But again, we want you to have healthy credit. I've seen how beneficial it can be for you if it is healthy, and I've seen how detrimental it can be for you if it's unhealthy. So again, we thank you for giving us this opportunity. Hopefully we've answered the questions you had in the chat, but we thank you again for giving us this first opportunity to step on this great platform with GOD Radio 1. And we look forward to the next workshop and really helping you guys. And remember, at BBVA,